U.S. Treasury Secretary Scott Bessent announced that the United States is on the verge of signing new trade agreements with several of its top trading partners, with India likely to be among the first. This development follows substantial negotiations with Japan and other Asian countries, as the U.S. seeks to avert tariffs and strengthen economic ties. Vice President Vance's recent visit to India highlighted significant progress in these discussions. The potential trade deals reflect a strategic U.S. effort to solidify alliances and reduce trade barriers in the Asia-Pacific region, potentially influencing market dynamics and investor sentiment. In parallel, Bessent noted China's decision to exempt certain U.S. goods from retaliatory tariffs, signaling a potential de-escalation in trade tensions between the two economic giants. While President Donald Trump is expected to play a crucial role in these bespoke trade agreements, the U.S. remains cautious about China's economic strategies. The outcome of these negotiations could have far-reaching implications for global trade patterns, impacting stock markets and economic forecasts. As the U.S. aims to finalize agreements with 15 to 18 key partners, the financial and geopolitical landscape may experience shifts depending on the success of these diplomatic efforts.
The recent report from Morningstar highlights a significant trend in the investment landscape, as U.S. investors have been withdrawing funds from ESG, environmental, social, and governance investments for 10 consecutive quarters. This outflow, amounting to $6.1 billion in the first quarter of 2025 alone, is partly attributed to the policies of President Donald Trump's administration, which has taken a firm stance against climate initiatives and diversity, equity, and inclusion (DEI) efforts. The Trump administration's withdrawal from the Paris Agreement and rollback of climate policies have intensified the backlash against ESG investing, leading to a notable shift in investor sentiment. Despite the political headwinds, the demand for ESG investments remains robust, with significant support from certain states and a growing interest among individual investors, particularly the younger demographic. Analysts argue that ESG investments are poised for higher long-term returns, as companies that embrace sustainable practices are believed to be more resilient and successful. This ongoing interest is underscored by a Morgan Stanley survey indicating that 84% of U.S. individual investors are interested in sustainable investing, reflecting a persistent appetite for values-based investment strategies despite the current political climate.
Ghana is positioning itself as a potential global manufacturing hub by leveraging the African Growth and Opportunity Act, AGOA, which offers it significantly lower U.S. import tariffs compared to Asian countries. James Bruce, Executive Director of Wholesale Banking at Access Bank, highlighted that while Asian exporters face U.S. duties as high as 60%, Ghanaian products are subjected to only about a 10% levy. This substantial tariff differential provides Ghana with a competitive edge, making it an attractive destination for investors aiming to export to the U.S. The opportunity to cut production costs could encourage manufacturing firms to relocate or expand their operations in Ghana, turning it into a strategic gateway for American-bound products. To capitalize on this opportunity, Bruce stressed the need for robust collaboration between the government, industry, and financial institutions. Access Bank, in partnership with Development Bank Ghana and the MasterCard Foundation, is preparing local small and medium enterprises for the anticipated influx of manufacturing projects. This preparation involves enhancing infrastructure, developing a skilled workforce, and establishing sound financial systems. Analysts suggest that by utilizing its preferential access under AGOA, Ghana could diversify its economy beyond traditional commodity exports like cocoa and gold, fostering industrial growth and job creation. As global supply chains evolve and trade policies become more stringent, Ghana's strategic location and policy reforms could attract increased investment and technology transfer, provided AGOA is extended beyond its 2025 expiration.
Prediction markets are gaining traction as a financial tool, with platforms like Kalshi and Polymarket at the forefront of this emerging sector. Kalshi CEO Tariq Mansour distinguishes prediction markets from gambling by highlighting their role in economic utility, likening them to traditional financial instruments such as grain futures. Unlike speculative gambling, prediction markets allow participants to take positions on natural risks, such as political events or economic indicators, which have broader societal implications. This distinction is crucial for regulatory considerations, as seen in historical Supreme Court decisions regarding futures markets. Kalshi's recent expansion into sports prediction markets reflects growing consumer demand for event contracts that offer insights into the economic impacts of major sporting events. These markets function similarly to stock exchanges, where participants buy and sell shares based on the likelihood of an event occurring, such as the outcome of the Super Bowl. The economic ramifications of such events extend beyond the games themselves, influencing local economies and industries associated with the teams. By providing a market-based forecast, prediction markets could potentially disrupt traditional sports betting by offering a more economically grounded perspective on event outcomes. This evolution of prediction markets underscores their potential to reshape how financial markets interpret and respond to various global events.
Microsoft is gearing up to release its fiscal third-quarter earnings report, with analysts suggesting a de-risked setup for the tech giant stock. Despite a recent dip, Jefferies analyst Brent Thill maintains a buy rating, setting a price target of $475, attributing the favorable outlook to resilient macroeconomic conditions and positive results from peers like Alphabet, SAP, and ServiceNow. Microsoft is expected to report a 10% year-over-year increase in earnings per share to $3.22, with revenue rising by 11% to $68.43 billion. The company's growth prospects are bolstered by its cloud computing and AI initiatives, particularly in its Azure infrastructure and Copilot's AI programs. However, conservative guidance is anticipated due to ongoing uncertainties, including the impact of Trump-era tariffs. Other analysts, such as Deutsche Bank's Brad Zelnick and Truist Securities' Joel Fishbein Jr., also uphold positive ratings for Microsoft, with price targets of $475 and $600 respectively. Zelnick notes Microsoft's recent underperformance relative to the broader tech sector, possibly due to cooling enthusiasm for AI investments amidst concerns over demand and monetization challenges. The acknowledgement of slowed AI data center projects by Microsoft has further contributed to this sentiment. Nevertheless, Microsoft's inclusion in the IBD Long-Term Leaders portfolio underscores its strong long-term potential, driven by strategic advancements in cloud and AI sectors.
President Donald Trump has proposed a $1 trillion defense budget for fiscal year 2026, aiming to establish the Golden Dome, a modern interpretation of Ronald Reagan's Strategic Defense Initiative from the 1980s. This ambitious plan seeks to create a comprehensive missile defense system using space-based interceptors, high-altitude sensors, and real-time tracking satellites to protect against threats for rogue states and adversaries. The initiative involves significant collaboration with private sector leaders such as SpaceX, Palantir, and Anduril, who are working on constructing a satellite constellation to form the project's backbone. This effort will leverage advancements in artificial intelligence and next-generation missile technology, potentially transforming the aerospace and defense sectors. The proposed budget represents a nearly 12% increase over current defense spending, reflecting a strong commitment to bolstering national security amid rising global tensions. However, the project faces substantial financial and technical challenges, with costs estimated to reach hundreds of billions of dollars. Additionally, global trade tensions and recent tariff hikes have increased material costs and supply chain uncertainties for defense contractors like Lockheed Martin and Northrop Grumman. Despite these hurdles, the aerospace and defense sector remains resilient, driven by increased demand for advanced military technology. Legislative support, such as the proposed Iron Dome Act, which allocates $19.5 billion for missile defense technologies, highlights growing government backing. The Golden Dome Initiative, still in its early stages, promises to foster significant public-private partnerships and drive technological innovation, potentially reshaping the defense landscape and stimulating economic growth. investors and policymakers are advised to closely monitor the initiative's progress.
European Central Bank (ECB) policymaker François Villeroy de Gallas has indicated that there remains a gradual margin for further interest rate cuts in the Eurozone amidst declining inflation. Despite global economic uncertainties fueled by U.S. President Donald Trump's tariff threats, Villeroy, who also heads the Bank of France, emphasized that the ECB remains poised to adjust rates if necessary. With inflation continuing to trend downwards, ECB policymakers are increasingly confident about implementing rate cuts in the coming months, although they are not inclined towards making significant adjustments. The ECB recently reduced its benchmark interest rate to 2.25%. Villeroy's remarks underscore the ECB's cautious yet proactive stance in navigating the current economic landscape, marked by protectionist policies and potential recession risks in the United States. While some economists forecast a U.S. recession, Villeroy dismissed similar concerns for France and Europe. The potential for further rate cuts is significant, as it suggests a continued accommodative monetary policy aimed at stimulating growth and stabilizing prices within the Eurozone. However, the muted appetite for large-scale rate reductions reflects a balanced approach to managing economic challenges without overreacting to external pressures.
Zimbabwe is actively seeking to attract energy sector investments during the IMF and World Bank spring meetings in Washington, aiming to tackle its ongoing power shortages. Despite licensing over 100 independent power producers, IPPs, with a potential capacity of 8,000 megawatts, only a small fraction is operational, contributing just 4% to the national grid. This shortfall has forced reliance on outdated state-owned infrastructure and costly electricity imports. Currency instability and non-competitive tariffs have been significant deterrents for investors, who are wary of the unpredictable returns due to the volatile Zimbabwean dollar and uncertain tariff adjustments. In an effort to mitigate these challenges, Zimbabwe has implemented policy reforms, including offering tariff guarantees pegged at 9 US cents per kilowatt for select projects to make investments more attractive. The government is also focusing on diversifying its energy mix by seeking investments in renewable sources like solar and wind, aiming for energy self-sufficiency and reduced carbon emissions. However, analysts stress that broader macroeconomic reforms are crucial to restoring investor confidence and securing the necessary funding for infrastructure expansion. As the meetings continue, Zimbabwe is expected to engage with potential investors and development partners to explore opportunities in infrastructure financing and public-private partnerships.
Investment bank Piper Sandler has issued a bullish note on Palantir Technologies, PLTR, suggesting the stock is likely to retest its February high of nearly $125 in the near to medium term. This optimism stems from technical analysis indicating that PLTR has emerged from a falling wedge pattern, a formation often seen as a precursor to upward price movements. The note also follows Palantir's announcement of an expanded partnership with Alphabet, Google, which will integrate Google Cloud with Palantir's FedStart project. This collaboration is expected to enhance the security and compliance of Palantir's offerings for federal agencies, potentially alleviating concerns about the company's government contracts. The strategic alliance with Alphabet is seen as a positive development for Palantir, as it could bolster the company's position in the government sector by leveraging Google's cloud infrastructure. Market sentiment around Palantir's stock may improve as a result, particularly if the integration leads to more robust government contract opportunities. However, some analysts remain cautious, pointing out that unanswered questions about Palantir's government contract exposure could still pose risks. Despite the positive outlook for PLTR, some investors might be more inclined to explore other AI stocks, which are perceived to offer higher returns within shorter timeframes.
Snap Inc. is set to release its quarterly earnings on April 29, 2025, with analysts forecasting an earnings per share (EPS) of 0.4 cents. the company's performance has been mixed in recent quarters, with a notable EPS beat in Q4 2024 that paradoxically led to an 8.36% drop in share price the following day. This highlights the market's focus on forward-looking guidance rather than past performance. Currently, Snap's shares are trading at $8.54, reflecting a 41.4% decline over the past year, which may contribute to a bearish sentiment among long-term investors. Analysts hold a neutral consensus on Snap, with a one-year price target suggesting a potential 26% upside. In comparison to its industry peers like Pinterest, Reddit, and ZoomInfo Technologies, Snap shows moderate revenue growth, but lags significantly in gross profit and return on equity, ROE. Snap's revenue growth rate of 14.4% places it in the mid-range among competitors, yet its gross profit and ROE are among the lowest, indicating potential challenges in profitability and financial efficiency. Additionally, Snap's high debt-to-equity ratio of 1.73 suggests financial strain, which could impact its capacity to capitalize on growth opportunities. The upcoming earnings report will be crucial for Snap, as investors look for positive guidance to restore confidence and potentially drive stock price recovery.